Hello and welcome back to the note on what has been a truly extraordinary day on the markets. We all were braced for the great divergence to continue as the ECB announced even easier monetary policy. It obliged, and the results were not what had been expected. As you can see from this chart here, which shows you daily moves in the euro against the dollar throughout the entire history of the euro, this was in fact the second biggest rise in the euro in its entire history that we saw today. That is even though the ECB announced that it was cutting rates and extending its QE program of bond purchases. Now, you would expect those measures to have exactly the opposite effect. The problem was in expectations. The ECB decided only to cut rates which are already negative by 1/10 of a percentage point. Markets were expecting more than that, and they opted only to extend the amount of time that QE can go on for. They didn't opt to expand the amount of bonds they buy at any one time. The problem for the ECB is that expectations matter. The market is used to the notion that when Mario Draghi really wants to do something, really wants to move the markets, he will stop at nothing, he will surprise them on the upside. So we had the paradoxical situation where people expected to be surprised. When they weren't, they acted very disappointed. Now, if we take a look at the bond market, this is the German 2-year Bund. You can see a really dramatic switchback there. You saw, frankly, even bigger switchbacks in longer dated bonds across Europe. That's because the ECB failed to expand the program. People had been buying longer dated bonds on the expectation that they would be able to sell them to the ECB. They were very disappointed at the notion that they might not be able to do so. Now, the idea of divergence isn't just that the ECB will ease, but that the US will tighten. People still expect that to happen, but look at the effect that this has had on the dollar. This is the dollar trade weighted index, very much affected obviously by the euro, but by other currencies as well. You can see a very dramatic pullback in the dollar today, also quite usefully for emerging markets. Emerging market foreign exchange enjoyed a strong recovery against the dollar today, which will ease the pressure on some of them. As for stock markets, plainly, stock markets really wanted some more easy money from central banks. What is very intriguing, however, is how fungible money is, how interchangeable money from one central bank or another proves to be. If we take a look at this in common currency terms, in dollar terms, so this accounts for the strong appreciation of the euro against the dollar today, you can see that the German DAX and the S&P 500 are now almost indistinguishable for the year. Both of them had a very bad day. Both of them are now down very slightly for the year. The reason it now appears that US stock markets were able to treat the prospect of higher rates from the Fed with as much equanimity as they did was that they thought they were at least going to get easier money from Europe. They are disappointed, and so you have seen a sharp fall once more. These stock markets are down for the year in dollar terms. Now, we have more expectations setting to worry about in the next 24 hours because we will very soon get the non-farm payroll report for November here in the US. It's the last critical data point before the Federal Reserve will have to make its decision on whether to raise rates, which it is certainly at this moment prepared everybody for. As it stands, we've had the first leg of the great divergence today, and as you can see from this chart here in particular, what it has instead led to, because expectations weren't satisfied, is a startling convergence in markets.